becomes new resistance. Let me explain why. The market is holding support here. Let's say that yellow dotted line is the euro 123. And it gets down there, it bounces, it gets down there, it bounces, and every time it bounces, traders who missed buying it are upset. Okay, so they buy it on this session here, and you bought at support. Congratulations, you bought at support, right? So this is where religion comes back to Wall Street or to the Forex trading world, because you say, please God, let me break even, and I'll never do this again. And you have dreams like this, okay?
Oh, yes, I did it.
Right? Right?
I admit that.
Right. So what happens essentially is the buyers, once it breaks support, the buyers, once the market breaks even, become what? Sellers, right, because they're thrilled. I mean, it's human nature. You're underwater, you're thrilled to break even. So old support, and this is just one of many reasons why the psychology of technicals works. So old support should become resistance, old resistance becomes support, because people are upset they missed the breakout initially. This is one of my favorite Western charting techniques, works well in all markets, all time frames. In fact, when I used to work at Hutton, when I used to actually follow bond futures, go back far enough, early 80s, there were Ginnie Mae futures that were so popular. And I used to look at what we back then called tick charts, which was different than what tick charts are now. But essentially, every trade was and it was just a line chart. And I use this technique all the time, just on line charts, tick by tick by tick. Works great in any time frame. So let's look at some examples. And it has to be a support zone tested at least 2 or 3 times, not just one support level, not just a bounce. So here we have a multi-tested support area. Old support should become new resistance. Okay. Some of you may have also heard of an internal trend line. I'm not real big on this, but just in case you come across reference, essentially it's just an angled trend line. And once the market breaks under it, the old support becomes resistance. I'm not crazy about this. I just really like horizontal support and resistance. But just in case you ever come across that expression, an internal trend line is an angled trend line. So here we have, see how old support became resistance. And what was extra ominous, and when I say extra ominous, it doesn't mean the market's going to fall further. It just means the odds of the market turning are higher. Is obviously we had a doji. And that would be a short sale for me, because the doji is confirming a resistance area. And what happened on the session after the doji to give us extra confirmation? What 3 candle lines before the candle line before the doji and after the doji? What 3 candle lines? What pattern did that form? An evening star, right? Even if it's a doji, it's an evening star. What we're going to look at now is one of my favorite indicators is if a market breaks a support area and can't hold it, it's very bullish. Or if the market breaks resistance and can't hold the new highs, it's very bearish. So let me go through this. The first one is the crack and snap. The market cracks under a support level, which should be tested 2 or 3 times. Cracks under it, and then snaps back above the previously broken support level. We could use that to buy. And what you should do is, this you could use an intraday stop. If the market indeed is solid, those lows, those intraday lows, should not be pierced. So you can keep a stop under the low, and your target is the most recent high. In equities, I like to see this confirmed by volume. So if the market breaks support, I like to see it break support on light volume, and when it springs back, the volume increase. But in the Forex, this is fine just the way it is. The reason something like this works, and the reason this works, and I'll go through it, the rationale behind it in a couple of minutes, The falling off the roof, it's the opposite of the crack and snap. The falling off the roof, the market has a very clean-cut resistance area. The bulls push above the resistance area, and then it pulls back under the resistance. Great short sell if the risk-reward is good, because your risk is to the high of the move, and your target is the most recent low, the pivot low. Now, the reason crack and snap and falling off the roof, and the reason I call this falling off the roof, by the way, is because there's a Japanese proverb that says, let him climb the roof and then take away the ladder. Okay, so this is this poor guy on the roof, and you're pulling away the ladder. It's a false breakout. And the reason for these work is because, especially if it's tested, and it should be tested many times, is do you think the stops are obvious? Right? And what are the big players going to do? Either if the market's at a very obvious support area or a very obvious resistance area, they know where the stops are. What are they going to do? They're going to gun for the stops. The market will push through the resistance, and those who pushed it up there, who are gunning for the stops, what are they going to do? Hang around? They're going to sell into it. Okay. Same thing with a crack and snap. Near a support area, if it's tested many times, they know, they being the large players, the interbank, the interbank traders, they know where the stops are. They're going to gun for them. So let's look at an example here. Here we have a bullish engulfing pattern, but it doesn't matter. Even if we don't have a candlestick signal confirming it, as soon as the market breaks under the support level and cannot hold the new lows, we can think about buying it. And in this case, the target would be the most recent high, the pivot high. Yes? No, it does. It could be. The question is, do I use a rule? How far under? It doesn't matter. And in this instance, you see how it moved under it intraday. Even if it closes under it, as long as it gets back above it within 3 sessions, you can use that technique. Now, obviously, if the market breaks under it by a lot and your target is not too high, it's not going to be a good risk reward. But there's no minimum amount. Okay, here we have a falling off the roof. See how the market poked its head above resistance and couldn't hold above it. So what's nice about this is that we have a target, which is the most recent low. And this is one important aspect about the Western technicals. Okay, we use Western technicals to get price targets, whether it's immediately preceding low. This is actually a Western charting technique derived by an equity trader in the 1920s, believe it or not. Because one of the things we have to be aware of is that candlesticks do not give price targets. They're great for reversals. That's what we use the candlesticks for. We don't use them to get price targets. Don't make candles into something they're not designed to do. The Japanese say, don't climb a tree to look for a fish. Okay? We use the candles for the reversals. We use Western technicals for the price targets. So the candlesticks, as shown by this cartoon, will show us the trend. It doesn't show us how far it's going to go. Okay? So we know the direction could be changing, but we just don't know how far it's going to go. And this is why we need to combine Western technicals with candlesticks. Okay. Okay. Here we have the doji confirming a resistance area. Yes?
In a situation like this, immediately after the doji has closed, you would feel confident buying on the open of the next candlestick?
You mean selling?
I'm sorry.
Selling, yeah.
And then you can just stop above the doji?
The question is, on the opening of the next candle, which is nothing wrong to do if you want to confirm the